This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fifth of 5 videos on trading the open. Most sessions begin with some kind of a breakout, and there's usually an early trading range. The breakout either comes from a trading range or it leads to a trading range. I'm going to talk about two particular patterns that traders see at the beginning of sessions. The first I call a breakout mode pattern, and that is where the market has a reversal down and a reversal up in a trading range. Either one can come first, and then traders look to enter on a breakout up or down. And then next, I pay attention to the first 18 bars. If the market breaks above the top of that range, usually it's not going to go back below the low of that range. If it breaks below the low of the first 18 bars of the session, it's usually not going to get back above the high. This is a 5-minute chart of the euro, two charts. All charts often are in trading ranges. For example, here's a trading range and then another one here. The market opened the session here, rallied strongly, and entered a trading range. Here, it sold off sharply at the start of the European session and entered a trading range. That's a trading range. In its breakout mode, the market could break out to the upside or the downside, but it's formed after the open of the session. This is the open of the session. And that's the same here. That is not what I'm talking about. It's a breakout mode pattern, a trading range. But in this video, I want to talk about special types of breakout mode patterns that begin at the open of the session, not after the market has already made a move. Again, 5-minute chart of the euro versus the dollar. And here the session opened. The market sold off at the beginning of the European session and then reversed up. This is the open of the European session for me. With Forex markets, you're never really certain when a session opens. You know when the Asian session opens, especially on a Sunday, but most of the time it's really hard to be absolutely certain of the exact bar when traders conclude that the session has begun. There's usually a breakout lasting 1, 2, or 3 bars, and it often reverses. For me, this is probably the open of the European session. And then here, same thing here. The market had a doji bar and then a big breakout bar, tried to reverse up. So it looks like trading is getting active here. You have small bars here, and now we're starting to get bigger bars and trend bars. This is a breakout mode setup, and I want to talk about what I mean by that. And this is a breakout of the first 18 bars. I pay attention to when the market hits the 18th bar, and if the market breaks below that 18-bar range, it's probably not going to go back above the top. If it breaks above the top of that 18-bar range, it's usually not going to break below the bottom. Therefore, in this particular case, once it breaks below the bottom of the first 18 bars, there's a 90% chance that the session will either be a bear trend or a trading range, and only a 10% chance it's going to reverse up above the top. That means that traders will be inclined to sell rallies, betting against a bull trend reversal. This is the breakout of the 18-bar session. This is a breakout mode pattern. You could call both breakout modes, but I use the term breakout mode pattern on the open to mean a specific type of a breakout mode. After the first bar of the session, I want to see a reversal up and a reversal down. Either one can occur first, and then traders will enter on a breakout above. They'll buy above, or they'll enter on a breakout selling below. Here's the 18th bar of the session, and I like to look for a breakout of that range formed by the first 18 bars. Here it broke below. Strong breakout, probably at least a little bit more down. Sometimes when you have a breakout of the 18-bar range, you also have a breakout mode pattern where you have a new low and a new high, both reversing, and then you look for a breakout. And sometimes breakout mode patterns where you have the new low and the new high, both reversing, is also going to be an 18-bar range breakout pattern. There's similar patterns. You're looking for an early trading range and then a breakout. I want to talk more specifically about the two different patterns. First, the breakout mode pattern. Here's the start of the US session, and you can see the day became a trend day. After the session began, there was a reversal down, and then there was also a reversal up. It's not clear to me whether or not this went below the beginning of the session. It looks like it did. In any case, once you get the reversal up after a reversal down, the market's in breakout mode. Bears are going to sell a bear breakout looking for at least a measured move down, and bulls are going to buy a bull breakout looking for at least a measured move up. I want the two reversals to be 10 or more bars from the start of the day. In other words, I want the breakout mode pattern to last at least an hour or so. And I want the height of the range to be less than half the size of an average day's range. If the range of this opening trading range is almost as big as an entire day's range, and then we get a breakout, chances are it's a trading range day and the breakout is not going to go very far. But if the initial range is fairly small, a third or a half of a typical day's range, and then you get a breakout, the breakout's probably going to lead to a move that will result in the day having an average day's range. It's a higher probability setup if you get the reversal down from above the first bar and a reversal up from below the first bar. This is just about the same as the low of the first bar. Again, you want the trading range to be at least 10 bars wide, and you want it to be no more than half of the height of a typical day's range, a recent day's range. Bulls will buy on a stop above, and they'll also buy pullbacks. If there's a strong breakout, they'll buy pullbacks. If the market begins to trend, they'll be buying for any reason on the way up. And they'll also sell on a stop below. Sometimes you'll get the buy and then the sell. And traders theoretically buy on a stop above. They have a protective stop below. And not only do they exit their long, but they'll go short. When I'm trading, if I take the buy and the market starts to reverse down, I do not wait for my stop to get hit. If it looks like I took a bull breakout that's reversing, I get out as soon as I think I'm wrong. This is the start of the US session, and it's a pretty weak start. Is this the start, or is this reversal the start? I don't know. It looks like the market is starting to try to break out here. Very quiet bars here, and it looks like we're starting to trend up. We went down and up. So somewhere in here is the start of the US session. Again, when you're looking at sessions, sometimes it's just not clear when traders decide that the session has begun. Sometimes a group of traders pick one time and then more traders come in, and at some point everyone agrees that the day has begun. Here we have a sell-off and it reversed up, and we have a new high and it reversed down, a breakout mode pattern. The pattern is probably not big enough. It's only a few bars between this reversal and that reversal. In the entire range, it's not really clear. Did the session begin here or did it begin here? This is not a particularly reliable breakout mode pattern, and therefore a lot of bulls are not going to buy the bull breakout. They'll wait for a bigger pattern or for some clearer pattern. Some bulls will take the buy or they'll buy a pullback. Here we pull back for a few bars. The bears trying to get a failed breakout. The bulls have another good bar and they could take the pullback buy. But again, the pattern itself is too small. For me, that is not a reliable breakout mode pattern. The legs up and down are small and the entire pattern does not have many bars. It does not look like the bears got trapped. This is not enough of a sell-off to indicate that there were a lot of bears selling. This looks like more of a tight trading range and not a market that's about ready to break out. Another tight trading range, a triangle. Some traders will start selling for a failed breakout above the initial range. Decent bear bar here, decent bear bar here. Certainly the bulls will have to think about exiting. If they bought up here thinking they were buying the start of a bull trend, and then they see this, a lot of them will exit and wait for another setup. Now we got a bigger breakout mode pattern. We have a reversal up and a bigger reversal down. Reversal up from a new low, reversal down from a new high. We got a breakout below the low of the pattern. This is a more reliable sell, but even then it still looks like a bear leg in a trading range. It lacks consecutive big bear bars closing on their lows. We have one big bear bar, but the second one is a big tail. Some traders will take the sell on a stop below the bottom of the pattern. Others will look to sell a bear flag, like below that low or below this low. This is not looking like the start of a big bear trend day. However, it looks like the bulls are giving up, and it looks like we'll go at least a little bit lower. Bears will either sell the breakout or they'll sell the bear flag below this low, or some bears prefer to sell below a bear bar below this low. Minimum goal would be a measured move down, which is what the market reached, but that's not much of a profit. That's about a 20 pip sell-off. With the market looking like this, it's unlikely to result in much of a big trend, and therefore you have to be going for a smaller profit. The session began and with a strong rally and a strong sell-off. We reversed down, and now we're reversing up. A reasonable breakout mode pattern. The bears tried to get the downside breakout, could not. Bulls trying to get the bull breakout, and they did. Higher probability of a breakout mode pattern if the market is trending. Here we have a series of bull bars, and here we have a series of bear bars. Bulls are committed, and they were trapped. Bears now are committing, and they're getting trapped, and they're trapped again. This has a higher probability of leading to at least a measured move up or down, depending on the direction of the breakout. Also, the range itself is not all that big. It's less than 20 pips, which is far less than half the size of an average day's range. Therefore, the breakout will probably lead to a reasonable trend and at least a measured move up. With the range only being 20 pips or so, the breakout could lead to a big trend, which it did. This is moving up nicely. We have 4, 5, 6 bull bars. Some traders will buy on a stop above the top of the initial range. Other traders prefer to buy the pullback, the bull flag, either buying above the prior bar, which is a bear bar, or buying above a bull bar, or buying other bull flags all the way up. Bulls who buy, they put their stop below the bottom of the range. Sometimes you get a deep pullback. This is a shallow pullback. Traders will buy a reversal up from the pullback, betting that the bull trend will resume. A breakout and a pullback, and then bull trend resumption. Sometimes after the breakout, the sell-off can be deep enough to make the market always in short. Yet, as long as it holds above the low of the initial range, the odds are the sell-off is simply a bear leg in a trading range day and not a bear trend. Bulls will therefore look to buy a reversal up. If the market pulled back into the range again, bulls would again buy a reversal up. If it pulled deeply into the range, it did not here. A lot of bulls will buy on a stop if it again breaks above the top of the range, not simply to a new high. If you get a deep pullback and it breaks above the top of the range, they'll buy again. Others will buy on a stop above the top of the new, bigger range. Becoming a strong bull trend, 7 or 8 consecutive bull bars, very tight channel. Traders are going to buy breakouts from every pause because every pause is probably a bull flag, which means the market is likely to go higher. This rally is probably the start of the US session. We have a reversal up from near the bottom of a trading range, and now we're getting a reversal down. Now we have another reversal up. This is the open of the session, probably. I say that because whenever you get a strong move up around the time when the session typically begins, 5 o'clock or so, then the start of that breakout is typically the start of the session. We got a reversal down after the session began. We got a reversal up here, but a lot of bear bars, a doji bar. Most traders will wait for a decent second entry buy. To me, I see down and up and down and up and down. We have a reversal up here. So theoretically, it's breakout mode. After the session began, we have a reversal down, we have a reversal up, and we have a breakout below. But the range is small, and the market's clearly sideways. Therefore, it's more likely that breakouts will fail than succeed. Some days stay as trading range days, and instead of a breakout leading to a swing down, you look to the left and you see the market's repeatedly reversing. Most traders are not going to sell on a breakout below the range or buy on a breakout above because they can see the repeated reversals. Also, the trading range at this point is only 15 pips tall from the bottom to the top. Even though the U.S. session is underway, here we are 6:30 Pacific time. The session typically begins around 5 or 5:30. We have a very small trading range day with no energy, no commitment up or down. I would not be trading this as a breakout. I would not be selling below the bottom or buying above the top. I would wait to see a strong breakout and then trade it as a breakout. If we start to get a series of bear bars, then I would sell. If we start to get a series of bull bars above the high, then I will buy. Some days simply remain a trading range day. And if you have a lot of trading range trading with not much energy, not much in terms of big consecutive trend bars up or down, these bars look big, but they're not. Look at the scale on the right. They're 5 pips tall, 4 pips tall. This is not a good environment for stop entry, selling at the bottom, buying at the top, looking for a trend. Better to look for reversals up and scalp. Once you have a reversal down and a reversal up at the start of a session, a lot of traders will front run the breakout of the trading range. And by front run, what I mean is if the market's starting to reverse up from the bottom, they'll buy, hoping that it breaks above the top. And if it reverses down from the top, they'll sell, hoping that it breaks out below the bottom. If they're disappointed by the size of the legs up and down, instead of holding on for a swing, they'll simply scalp out. In other words, when the market is small like this, traders are betting on reversals instead of breakouts. So if you get a second entry buy near the bottom, they'll look to buy. If you get a second entry sell near the top, they'll look to sell, betting against a breakout to the upside, betting against a breakout to the downside. Some traders might take a chance selling this, 2 legs up, 1, pullback 2, after a strong leg down, hoping that it's a bear flag, a pullback from this breakout to a new low. However, they know that the range is really small, the bars are small, there's not much energy, and this probably will not result in a swing down. If they take this sell, they'll be disappointed by the tail, the small bars, and the reversal up. They'll get out with a small profit. Basically, a break-even trade. It's always dangerous selling at the bottom of a trading range, even if it's a pullback from a breakout below the range. I'm now going to talk about that other type of breakout pattern that you get at the beginning of a session, and that's a breakout of the first 18 bars. Here we are at the end of the US session, and we're starting to get very small bars, and the range is getting very small. What's the chance that we're going to go down to a new low of the day? If I'm 99% certain at this point that I'm not going below the low, maybe 95% certain at this point, and maybe at this point, maybe I'm 60% certain. How many bars into the session do I become 90% certain that the market's not going to reverse to a new extreme? If you look at charts and count bars, you'll discover that by the 18th bar of the session, there's a 90% chance you've seen either the high or low of the session. Let's say this is the first bar of the session. What are the chances that this low will remain the low of the day? Well, the first bar of a session has only a 20% chance of being either the high or low of the session. And you can see today, if you bought above it, we got our new low. What about the first 7 bars of the session? By the close of the 7th bar, there's a 50-50 chance the high of the 7-bar range will remain the high of the day, and the low of the 7-bar range will remain the low of the day. Here, we got a new low and a new high. However, by the time you have 18 bars into the day, if you get a new high, then 90% chance the day is either going to be a bull trend day or a trading range day. Only 10% chance you're going to get a new low. The opposite is true if after the 18th bar you get a new low. Then only 10% chance it's going to go back to a new high, and that means the day will either be a bear trend day or a trading range day. If it's a bear trend day, you sell, you make money. If it's a trading range day, you sell. If it goes higher, it's probably not going to new high. You sell more and then buy back your shorts or on your original entry, profit on your second entry, and break even on your first. And that's why bulls will buy here. At this point, here's 18 bars. We're breaking above the 18-bar range. At this point, 90% certain the market's not going to fall below this low. And therefore, if you buy here, one of two things is going to happen. It's going to go up and you make money, or it'll go down but stay above this low. You can buy more and exit when it gets back up here. So you'll make money on your second entry and break even on your first. I've mentioned this before. Whenever you have a strong move at the open of a session, 50% chance it's the wrong way. 50% chance of any strong move up or down will reverse. Therefore, if you see a strong move up or down, don't become committed. Don't become convinced this is the start of a bull trend day or this is the start of a bear trend day. Only 50% chance this is going to be the start of a swing up. Only 50% chance this is going to continue down. 50% chance strong moves on the open reverse, no matter how strong they are. I want to talk about some 18-bar ranges at the start of a session. Here's 18 bars. Each one of these blue boxes is the first 18 bars of the session. And once you get a breakout of that 18-bar range, 90% certain you're not going to break out beyond the other side of the range. Here, the first bar of the session remained the low of the session for most of the session, 5 or 6 hours. These are 5-minute charts. We have a breakout above the 18-bar range, but instead of breaking out strongly, we're reversing. Some traders, instead of buying up here, will reverse, and the traders who do buy, a lot of them will exit. And then here, instead of a bull flag, we're getting a bear breakout. 2 big bear bars closing on their lows. The bulls are giving up, and now it's telling us we're probably going to try to break below the bottom of the 18-bar range. This is 4 or 5 bear bars, but by the close of the second bar, it looks like the bulls are giving up and the bears are taking control. This is probably going to lead to at least a measured move down based upon the height of this range. It led to much more than that. This is very late in the session to be selling a breakout, but theoretically, there's only a 10% chance after the bull breakout that we're going to get the bear breakout, and we're now in a bear trend. If there's enough time left in the session, you could take the sell Otherwise, if you're right in the final hour or so, you're probably not going to get much of a sell-off. Also, most reversal days do not lead to big opposite trends if the initial leg was pretty big. This is a pretty strong bull leg. If you get a reversal day, usually 80% of the time, it's not going to break strongly below the low and become a bear trend. Usually, it's going to stall somewhere around the earlier low. Trading range, here's the breakout of the 18-bar range. You can either buy the breakout or buy a pullback here or here. The bears are trying to reverse it and they're trying to get a bear breakout, but they're failing and we're reversing up again. This is a reasonable buy, betting that this represents bears who are now trapped as it's reversing up. The bears are failing to get the bear breakout after the bull breakout, and therefore we're probably going to repeat the bull breakout and we have a decent chance of at least a measured move up. Strong breakout, try to reverse down, breaking out again, and then pulling back. So small double bottom, this low, that low. Bull body, okay, buy, looking for higher prices. We're getting near the 18th bar, and we're getting a double bottom above the moving average, decent bull bar. Some bulls will buy this, betting that we're failing to break below the low, and instead we'll probably try to break above the high. That's called front running the signal. A lot of traders are waiting to buy the breakout, and you're entering in front of them. The first bar of the session remained the high for the next 40 bars, although the market was sideways for 50 or 60 bars. The bulls got their breakout, a reasonable buy. However, it failed and reversed. These two bars represent the bulls giving up and the bears selling aggressively, looking for a bear breakout after a failed bull breakout. They're looking for at least a measured move down. Very tight range for several hours. Bull breakout failing, reversing down strongly, probably are going to get a measured move down after the failed bull breakout. 18-bar range. Pretty good sell-off, reasonable to take the short, hoping for a swing down. Bad follow-through, looks like a possible failed reversal. And then look at this, a pretty good bull bar and a bull follow-through bar. This bull bar is a lot of the bears giving up, buying back their shorts. However, it became a lower high in a broad bear channel, and the market continued down. If a trader got out of his shorts, let's say he shorted here, and he got out above these bars or on that close, he's got to look to sell again, maybe below the spare bar or maybe on the close of the spare bar, looking for a failed reversal up and a lower high in a bear channel. 18-bar range ended right here, and we're getting a breakout. Not much energy. The market lacks consecutive big bars up or down, a lot of overlapping bars, a lot of prominent tails. It's a bear breakout, but it's probably not going to result in a big bear trend. Therefore, traders bet that this is probably a bear leg and what will end up as a trading range day. They're betting on a failed breakout. They could buy above this bar, or they could wait for this micro double bottom, decent bull bar, and buy above this bar, taking a chance that we'll get up near the high of the session. This is important. The market rallied strongly, but failed to get above a new high. Pretty late in the session to sell a reversal down. Also, after this many good bull bars closing near their highs, I would not sell the first reversal down. Here's the 18-bar session low. We're trying to reverse up. Very strong sell-off, reasonable to sell below the low, but it failed. It reversed up, and now it's reversing up a second time with even a better buy signal bar. So most bears will exit, and bulls will start to buy, betting that this will be a trading range instead of a bear trend. Again, failed to make a new high by the end of the session. So the top of the 18-bar range after the breakout to a new low held for the remainder of the session. The market often enters into a trading range early in the session, and that creates two kinds of breakout mode type patterns. The first one I call a breakout mode. I look for a reversal up and a reversal down after the first bar. I want the initial trading range created by those two reversals to have at least 10 bars in it. And I also want the height of the range to be less than half the height of a typical day's range. And if the momentum up and down is pretty good, traders will buy on the stop above the top of the range, and they'll sell on the stop below the bottom. If they buy above, their protective stop is below. If they sell below, their protective stop is above. And then I also pay attention to the first 18 bars of any session. If the market breaks below that 18-bar range, only 10% chance it's going to later reverse above the top of that range. If it breaks above the top of the range, only 10% chance it's going to break below the low of the range later in the day. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fifth of 5 videos on trading the open.